And this morning we bring in John Lipsky. He's the first Deputy Managing Director at the International Monetary Fund. He's the IMF's #2, and he joins us this morning from the IMF's Washington headquarters. John, thank you for sharing your time. Let's talk about what happened in Europe, of course, that $1 trillion loan package. Now, we just heard from ECB's President Jean-Claude Trichet, I guess, hinting that there were some dissenters among the EU members. I mean, what does this mean to you, that this was a forced hand?
Well, no, this was a very big step by the ECB in support in conjunction with the actions taken by the euro area countries and supported by the EU more broadly. First, let's start, because I think the real bedrock of this program that was announced is going to be ultimately the actions taken by individual countries to adjust their economies, to reduce their deficits, and to introduce structural reforms. The European community, basically the euro area countries with some other EU countries, have constituted the European stabilization mechanism to provide funding, if needed, to euro area countries in support of their adjustment programs, along with the IMF. We can talk about that later. And then the ECB announced its willingness to intervene directly into private and public debt markets to avoid disorderly situations. They also announced some other liquidity provisions. Buying bonds, that was a big step by the ECB. They say they will sterilize it, but it was a big step for them to help calm markets.
Yeah, John, there are still bears on the market, of course. Let me play for you Jim Rogers, the famed investor. I spoke to him just before this EU package was announced.
I'm sure there'll be some kind of papering over it, which will come out of all of this. Politicians try to push things off into the future so that they don't have to deal with them. But this is all going to make the situation worse, not better.
So does this make the situation worse, John? I mean, people are looking at this as just another form of money printing once again, and really you're not tackling the real issues and the fundamentals of these poorly managed economies. In fact, they're just throwing money at it.
Oh, I don't think that's true at all. First of all, I can see that the market seems to have disagreed with Mr. Rogers. They rallied very substantially in the wake of the announcement of this package. So right now, most investors think things have been made better. Also, let's look at, in concrete terms, at the first actual program that is within the adjustment program within the euro area, and that's Greece. The actions taken by Greece are anything but superficial. They've been very profound. They're a plan to reduce the budget deficit, to shift the budget situation by 16% of GDP over a 3-year period, and it's kicked off with a strong series of measures that have already been implemented and approved by the Greek Parliament. Now, no one's saying that this is easy, but it would be simply unrealistic to say that nothing important has happened. To the contrary, it's an important step. Now let's see what happens in other countries that need to undertake adjustment programs. Maybe they will need financial support, maybe they won't. But at the end of the day, it's the actions of the individual countries that will be most important.
Well, let me talk to you about the fallout, the political fallout for some of these European leaders. For instance, we saw Angela Merkel and her CDU party, the Christian Democrats, defeated in important regional elections. And some are pointing to this bailout package that she has to endorse that will go to Greece, possibly Portugal and Spain. Do you think that this is probably a highly unpopular move for politicians? I mean, what are their concerns right now?
I think the most important thing is to first bring stability to European markets and to world markets generally. That has succeeded. Secondly, to clarify the ambiguities that previously existed about the availability and the terms under which euro area countries might be willing to support fellow other countries in the euro area that were in difficulties. Third, to clarify what the role of the IMF would be within the Eurozone. Previously, some Eurozone members and other officials had said the IMF shouldn't be involved or wasn't needed. All of that got clarified. A mechanism got created. The IMF was made an integral part of this process, and the countries are going to be incorporated also into a new deficit control and reduction process that will be announced in the next few days. Now, there's no guarantee that all of this will be successful, but the effort is really quite significant and substantial. It has a real chance of success, and if it is successful, it will be politically popular.
Okay, John, well, I'll phrase it this way then. Do you think there will be more electoral casualties because of this massive trillion-dollar package?
Oh, Susan, I'm an economist working at an international financial institution, not a politician. So what's important is that the authorities in Europe have taken a significant step forward to clarify ambiguity, to provide financial funding, and to incorporate IMF support integrally into the process of fiscal adjustment, budgetary adjustment, and structural reforms that is absolutely necessary.
Okay, John, let me ask you this. What about countries that were looking to get into the EU? I mean, with all these deficit problems, the debt crisis here, do you think it's safe to say that some members probably don't want to join the EU anymore? Or some countries looking from the outside don't want to get in anymore?
Well, first of all, the EU is pretty big as it is, 27 countries. Certainly there are potential additions to that membership. Critically, of course, is going to be the growth of the euro. And there are many EU members that are still outside the euro. So the success of the measures announced yesterday and to be announced going forward in giving the euro area more solidity, more integration, and a stronger structural framework or institutional framework, and to clarify its relationship to the IMF, if successful, is going to make the euro area economy more successful. The more successful it is, the more others will want to join.
Yeah, John, I want to bring up the euro. Let's talk about the common currency, because I just spoke to famed investor Barton Biggs, who's predicting the euro to hit 1-to-1 to the US dollar. And there are still some really big short positions on the common currency at this point. Are you concerned that maybe we might see a big plummet in the euro?
Well, that was certainly a risk prior to the latest announcements. Now there is I would suggest, much greater certainty about the outlook for the euro area. But remember, exchange rates fluctuate; they tend to move. It's not clear at this time that in a broad, medium-term, multilateral perspective that the euro is far away from a reasonable valuation right now. But of course, it's already been much lower earlier. It's been higher. Exchange rates fluctuate, but the important thing is that the euro area economy has the prospect for better institutional solidity and greater economic efficiency if the adjustment programs that are going to be announced in the next few days and in the future are more likely to be successful.
Okay, John, thanks for sharing your time with us today. That's John Lipsky at the IMF.